United Healthcare, a prominent healthcare company, has had positive developments in its financial performance in 2022. The company's revenue has increased by 13%, indicating growth in sales. Additionally, its net income has shown a great increase of 16% year over year as well, reflecting improved profitability. However, the stock price has experienced a minor decline of around 2% year to date. Today we'll take a three-step approach to thoroughly evaluate UnitedHealth and determine its fair value. Step 1. Margin of safety. In this step, we'll look at UnitedHealth's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into UnitedHealth's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of UnitedHealth's business. By using these methods, we can determine whether the stock is currently overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of UnitedHealth as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. Margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. EBIT has gone up over the years, going from $5.6 billion in 2013 to over $20 billion in 2022. The average EBIT growth during this period is 16%, which, looking at our scale, is a 5% deduction in the margin of safety. The margin has also gone up, going from 4.6% in 2013 to over 6% in 2022. The average margin growth is 4%, which is once again a 5% deduction from a margin of safety. The next metrics that we'll be using are the dividend growth and the payout ratio. The dividends have gone up over the years, going from $2 a share in 2015 to $7.52 a share in 2023. Average dividend growth during this period is 18%, which is a 10% deduction from a margin of safety. This with a payout ratio that is currently sitting at 30%, which is no change in the margin of safety on this metric. And the final metrics that we'll be using are the debt to EBITDA and return on invested capital. To get the debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt, and for UnitedHealth, this is under 1 year, with a 93% debt to EBITDA ratio, which gives them a 5% deduction from margin of safety once again. The return on invested capital for UnitedHealth is sitting at 9.5%, indicating that the management is relatively effective at allocating capital, but not quite good enough yet for another deduction from margin of safety. It's looking very good so far though for UnitedHealth, so let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of UnitedHealth going from 2013 to 2022. The average growth rate in their free cash flow annually during this period has been just under 18%, and I'm projecting their future free cash flow to grow by 8% annually for the next 10 years. With this percentage, we'll determine the future free cash flow for UnitedHealth and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $540.4 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of over $510 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $548.58, which is almost a 9% increase from current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of UnitedHealth going from 4 years ago to the current year. The average growth rate in their dividends during this period has been sitting just under 15%, and I'm projecting all of their future dividends to grow by 8%, and I'll once again be using a discount rate of 9% in this valuation. And this gives us a dividend discount model price per share of $812.16, which is almost a 61% upside out of this model. The next model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that UnitedHealth is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value of $436.87, which is a 13.4% downside from the current price. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to UnitedHealth, look at their stock price and their earnings per share, and this way we can determine the average PE multiple in the industry, which in this case is sitting at 18.81. All that's left to do then, to get our fair value, is to multiply by the earnings per share that UnitedHealth is generating, which is $22.34 a share, giving us a fair value of $420.21, which is a 16.7% downside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years, and on average it has been sitting at 1.33%, while the current yield is sitting at 1.35%, indicating that it's very close to fair value on this metric. Doing the same with the PE ratio, on average it has been sitting at 20.67, while the current PE ratio is sitting at 22.58, indicating that you're paying a little bit more for their earnings in this case. This gives them a fair value of $486.98, which is a small downside of almost 3.5% out of this model. Let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $540.96. On margin of safety, we've determined earlier using a standard margin of safety of 25%, deducting by 5% for the debt to EBITDA, EBITDA growth, margin growth, and payout ratio, and deducting it by 10% for the dividend growth, leaving them with no margin of safety at all, meaning that the fair value is the same as the average out of our models, and with the current price of $504.48, we get a small upside of 7.23%, indicating that's currently a buy out of our valuation. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.